What's up, everyone? How you doing? Welcome to the channel. Um, it's your boy Smart, and today we're going to be talking about how insurance companies make their money. So, if you're new to this channel, please like the video, subscribe to the channel, turn on your post notifications so you get notified when I upload new videos, and share the video. I really appreciate that. So, like I said, today we're going to be talking about how insurance companies make their money. So, without wasting much time, let's get to it. First, we have pricing and assuming risks. Revenue model specific among health insurance company, property insurance companies, and financial grantors. The first task of an insurer, however, is to price risks and change premium for assuming it, and charge premium for assuming it. Suppose the insurance company is offering a policy with $100,000 conditional payouts. It needs to assess how likely a prospective buyer is to trigger the conditional payments and intend that the risk is based on the length of the policy. Yeah, that's basically it. Let's get to it. This is where the insurance underwriting is critical. With good underwriting, the insurance company would charge some customers too much and others too little for assuming risks. This could price out the least risky customers, eventually causing rates to increase even further. If a company prices its risks effectively, it should bring in more revenue in premiums than it spends on conditional payouts. In a sense, an insurer's real product is insurance claims. When a customer files a claim, the company must process it, check it for accuracy, and submit payments. An adjusting process is necessary to filter out fraudulent claims and minimize the risk of loss to the company. So, all of this is basically what we've talked about previous videos, sort of. So, but not how insurance companies make their money. I think this is the first time we're discussing it on this channel. Now, price assumption, and then charging for that. The insurance company needs to make sure that they are taking into account every possible, even when you, like I just said in the last video, even when you file for a claim, the insurance company has to investigate to make sure there's no fraudulent activity, to make sure you're not trying to maybe raise a false alarm, or maybe, for instance, you insure your car and then your car got lost and then you're just trying to get a new car. The insurance company, if they find out anything doesn't add up, they're not going to pay you. So second way of insurance companies making money is interest earning and revenue. Suppose the insurance company receives 1 million in premiums for its policy. It could hold on to the money in cash or place it into a savings account, but that's not very effective. At the least, those banking or savings are going to be exposed to inflation risks. Instead, the company can find a safe short-term asset to invest its funds. It generates additional interest revenue for the company while it waits for the possible payout. Common instruments for this type include treasury bond, high grade corporate bond, and interest bearing. This is just like the same way. It's just like the same way of putting your money in the bank. There's a saying that if everybody that has their money in the bank goes today and asks the bank for the money, the bank cannot pay everybody at the same time. What it means is, another way of insurance companies making money is putting your money to work and waiting for when an insurance claim comes in, so they can invest in short-term asset, long-term, whatever it is, and then make more money. Because putting it in a savings account, like I said earlier, is going to increase the risks of inflation, and then the money is not going to work as much as it should or used to. So that's that. reassurance. Some companies engage in reassurance to reduce risks. Now, reassurance, we've talked about reassurance company if you remember. Reassurance is a company that buys products from themselves from excessive loss due to high exposure. Reassurance is an integral component of insurance. Reassurance is basically the insurer, like the insurance company, insurance company have insurance company that they go to. You understand? It's like a bank, and then you're having like a central bank or a Federal Reserve. So that's what that is. So evaluating insurers by smoothing out the influences of business. Reinsurance makes the entire insurance sector more appropriate for investors and all. And then I'm just going to skim into the next one. Compete weeks free with $100,000 in virtual cash. Yeah, and then that is just about it, and how insurance companies make their money. I'll be talking about that in my next video, or if you want me to still throw more lights on that, you can let me know. I can make a full video about that. But for now, stay strong, stay fit, and stay safe. Like the video, subscribe to the channel, and share the video. Thanks.